UK government bond yields jumped huge. Here's our take. I'm Bob Stokes with Elliott Wave International. Let's talk about the one market that plays a huge role in the global economy, yet it's poorly understood by an average investor, and often it intimidates even professionals. Bonds, also known as interest rates. Government bonds, corporate, municipal, investment grade, junk. It's a huge and complicated market. For starters, when bond prices rise, their yields fall, and vice versa, because it's also a so-called fixed income market with fixed returns. And as just mentioned, its role cannot be overstated. Gilts are bonds issued by the British government, the equivalent of treasury bonds in the U.S. Just like treasuries, gilts come in different maturities. And about a month ago, the spread between the 10 and 30-year gilts garnered historic attention. UK bond market chaos sends investors fleeing into money market funds. That headline published in the wake of some of the biggest ever jumps in UK government bond yields, meaning also biggest ever sell-offs in gilt prices. In Elliott Wave International's view, that turbulence signaled a major liquidity crisis, as well as instability. And it wasn't exactly a surprise. Our monthly European financial forecast gave a heads-up warning as far back as September 2nd. Volatility and hedging costs in the credit markets are rising, and liquidity is evaporating. All of these trends stand to accelerate. Less than a month later, on September 28th, the Bank of England was forced to purchase £65 billion in long-dated gilts to stem a material risk to UK financial stability. Now, our November European financial forecast provides an update with this chart and commentary. Every bar on the histogram represents a single day's change in the spread between 10-year and 30-year gilts. On most days, the spread moves by negligible amounts. The red square highlights the 2008 financial crisis with daily swings up to 20 basis points. Likewise, the series of sovereign debt crises that plagued Europe from 2010 to 2012 saw 20-point swings. Last month's trading shattered these prior records as the spread swung by more than 50 basis points in a single day. The Bank of England was essentially forced to buy the bonds because nobody else wanted them. Ouch. The question is, are British government bonds out of the woods? Well, yes, gilt prices have recovered strongly off their early October lows and yields fell. But the rally looks corrective, meaning when it's over, gilts are likely to tumble again. In our view, it's all part of a broader social mood decline, which is covered thoroughly in Robert Prechter's Last Chance to Conquer the Crash. The book's message about how to prepare for this decline ties in well with the region-specific turn-by-turn analysis offered by our European financial forecast. Learn how you can access both via a special offer by looking below this video.